Welcome once again to the Allon Exchange Retirement Planning Strategy Show for you with Jay and Brittany Hagee. They are the co-founders of Allon Planning Partners. I'm your host, Spike Spangle, and we have an incredible show today. We're going to be talking about the markets, strategies, what to do about them, and I hate to say this right now, the possibility of being in a bear market. Start with you today, Jay. How are you doing?
I'm doing wonderful. I'm excited to talk about this and where we're at in our economy and like how we can help folks not really make irrational and fear-based decisions through this time. So excited about it today.
Yeah, Brittany, a lot of folks do react emotionally, especially when it comes to investing. We react either through fear or greed. And so what we want to do today is kind of provide the technical information, but more so what you do as financial advisors, you're not just broadcasters. We're not just going to talk about negative news. You help people with solutions, ideas, thoughts, and processes and goals, right?
We want to focus on the positive. We got to acknowledge what's really happening, which is what we're talking about today. But we want to offer those solutions because there are options. There are things that we can do in situations like this. There are solutions. We always want, that's something that my grandfather actually taught us. He passed away a couple of years ago, but man, he always said that there is always a solution. And there is. We just have to be willing to shift our perspective just a bit when it comes to things like this.
Right. So would you both say that we are in the midst of a bear market right now? We know things have slowed.
We definitely
we
are.
absolutely are. And you know, in the last year, we've technically and emotionally hit a bear market. You know, you can see the panic. You know, so a technical bear market is from the highs, recent highs we've hit, 20% drop or a 20% decline. So when we see that, we are technically in a bear market, and we've been there for a little while now.
Right.
And so it's often caused by economic unhealth in general, which could be the inflation that we've seen with our shrinking economies, you know, shrinking GDPs, you know, from corporate losses, you know, earnings not being so good. All of these things cause the markets to shrink back and to decline, and that's what we've experienced over the last year or so. So 2022 was not a fun year for a lot of people, and so that's why we wanted to dispel some of the myths that we see about a bear market and bring some truth and some hope and some light to folks today.
Well, look, I know that I studied a bit of economics in college. We know that there are cycles, right?
Absolutely.
These things are bound to happen.
That's correct.
Can't avoid it. It's just like the changing of the seasons. They're going to come and go, and sometimes they'll last a little bit longer. So are we at the beginning of this one? Is this a season that could pass mildly, or could this be a rough winter?
Yeah, and sometimes, you know, you turn on the news and you'll have differing opinions on this, right? There's a lot that goes into how long are we going to be stuck in this cycle. We do know that we're in a cycle. If, you know, everyone could always pick the perfect bottom and pick the perfect top, everyone would be rich. You know, that's not what we try to do, but we look at, you know, is it raining outside? We take an umbrella, and we kind of see we're in the midst of this financial storm right now. So it could be a little bit more volatility ahead for us because there's still a lot of things that need to be fixed in our economy. And so we've got to try to correct ship, so to speak. But we want to speak to folks today on what the bear market is and that it doesn't always last. You know, bull markets don't last forever. Bear markets don't last forever. We've experienced a 10 to 12 year bull market run, you know, and now, you know, how long are we going to experience this bear market run? And all we can do is look back at what's happened and say, how long do these things usually last? What's the drops usually look like? And what should we expect? And why is this one different? Or is this one kind of what we've experienced
and there's
before?
some things we can do in the midst of these types of market cycles to really bring some ease and peace of mind. First of all, don't allow those emotions that you're feeling to be what's driving your decision making, because that most often is going to not end well when we're driven by things like fear or greed, like we talked about. Not making those fear-based decisions. And something else that's really practical that we need to do is ensure that we have enough expenses or enough dollars within our savings accounts to cover unexpected expenses, or if we lose a job, or if something unexpected happens because of the economy. To know that I have enough money set aside to cover this unexpected event, that can bring peace of mind and help a bit through these rocky waters.
Nobody really seems to enjoy those setting up an emergency fund, but that's what an emergency is for. An emergency, can that be defined as a bear market or a job loss in the bear market? That's what you set the fund up
That's
for.
exactly why you have them,
the
and exactly
purpose.
why we ask folks to set up 3 to 6 months of their income in an emergency fund that, this isn't investable assets. I have folks come to me all the time and say,
Yeah.
I have an extra 3-6 months of expenses set
Cash.
up in cash over here, and I really want it to be working for me in some other way. And I go back and say, listen, you need that emergency fund. You need that nest egg. You cannot take everything you've got and invest it in different ways. Then you'll be pulling from those investments in times you should not be, which is the bear market
Which
that
locks
we're
in market
and
losses,
locks in
which
your
increases
losses.
tax liability. There's too
it's
many
huge.
negatives
Yeah.
for that.
Yeah, so
Yeah.
if I could just take a minute, I believe we have a chart. I want to dispel and kind of shine some light on what a bull and a bear market cycle actually looks like in the past, or has looked like. So the average bear market lasted about 446 days, and the average bull market actually lasted a little over 2,000 days. So you can see the returns in the blue and the losses in the red. The average bear market loss is about 38%, 38.4%. But the average bull market gain is 209% on average. So when you look at it, being and staying invested is how you want to react and respond in these moments, if you are properly invested. So as we look at this, we should not it should take some of the fear out of it and say, oh, when bear markets have happened in the past, they may have been an extended period of time. But ultimately, if I can withstand and withhold and I'm properly allocated for my situation, I will regain and I will come out the other side even stronger than when this storm started.
That is key right there, to be properly allocated. Because if you're not in the appropriate risk tolerance for
That's
where
what we
you
help
are in
with.
your life,
Yeah.
man, that's detrimental. That can be very detrimental.
Okay, so
to
how do you help
portfolio.
people know if they are in the right risk tolerance for where they're at, their age, and their goals?
Yeah, there's a number of factors that determine that. We've got to look at exactly those things you mentioned. Your age, as you near retirement,
What's your
technically
time
you should be
horizon look like?
taking,
Yeah.
you should be taking less risk. What do your goals look like? What are you trying to do with what you have? I mean, all of these things you've got to take into consideration.
And just like when you're physically feeling sick, you may want to go see a doctor. If this bear market has you feeling sick, come and see us. That's why we examine these things for you. We look at your time horizon. We look at your risk tolerance. We look at how you're allocated, because you may actually not know. A
Right.
lot of folks think that their account is doing great because we were in a large bull market for a long time. And then we get in this bear market cycle, there's a lot of tension and a lot of stress and a lot of fear. And so you may still be okay, just like I showed you that chart. If you have the time horizon and you're allocated correctly, stick it out, stay where you're at. Maybe that is the right call. But if you're feeling that much seasickness, then you need to come see a doctor. You need to come see a financial professional.
That's something else you have to consider when talking about risk tolerance, is how do you handle it when the market does decline?
Yeah.
How does that impact you? Because for some, they can stomach those losses and know, okay, I just ride the wave when it
Right.
comes back up. But for others, it impacts them in some really hefty ways, and they can't really stomach that. You just have to know yourself enough to know what's your threshold, what's your limit, and that's got to be considered in risk tolerance conversations.
We're
as
going to
well.
have to take a very short break right now. There's a lot of folks who are worried about being in a bear market. More importantly, is your nest egg going to last all the way through retirement? Jay, maybe you can tell us a little bit about a review before I take a break real quick.
Absolutely. And when you come in, if you are feeling this fear and you're feeling this market volatility and it's got you shook up, or you can't sleep well at night, you're not alone, number one. A lot of people are feeling the volatility that you're feeling. And we meet with those people week in and week out. And what our job is to assess your situation. We're going to look and take a look under the hood, so to speak, of your portfolio and make sure that the allocation is appropriate for you. We're going to bring you peace of mind to say, okay, here's the truth. You are allocated correctly and you need to hold on, or maybe we can make some minor tweaks along the way, because the plan should be fluid. Or we may have to say, yes, you're absolutely right, and your fears, are validated, and that we need to make some major changes to your portfolio. So we're going to take a look at your portfolio and analyze that. We're going to take a look at your income plan, your tax plan, your estate plan. It's a comprehensive review, but leave your checkbooks at home. We're not trying to sell you anything. We just want to make sure we're bringing you that peace of mind and that you have that value add that we can bring.
Thank you so much. We're going to take a very quick break. When we come back, we're going to answer the question, which investments are best during a bear market, was one of our viewer questions. More at the Allon Exchange and Jay and Brittany Hagee right after this, but call the phone number so you can get your own complimentary review, or poke that QR code down on the bottom of the screen. Open up your phone to the camera function, point it at it, just like you've done at menus at restaurants, and click on it. It's going to take you right over to their website. 866-691-7317 is the phone number for you to call. More with the Allon Exchange with Jay and Brittany right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just a downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to the Allon Exchange with Jay and Brittany Hagee of Allon Planning Partners. We have an incredible program today. Jay and Brittany are talking about where we're at in the markets. We have to admit, we know we're in this bull market right now, or this bear market. I'm sorry, we were in the bull market, but boy, that would be really nice right now.
It would be.
I've got a question, though, from one of your viewers. I've got Maggie in Cleveland. She said, during uneconomic certainty like we're in right now, what are the best investments to be in for a bear market? Now, it's a great question, but all right, I will let you guys take it. I know where I
want to start one place here. You know, when we get this question all the time, but different. It looks a little different. I had another person call in last week and said, should I invest all in gold? Should I have everything go to gold right now because the volatility is going crazy, right? So people are trying,
cash. Do you get that as well right now?
I have folks come in and say, I'm in all cash, right?
Someone say about crypto.
Crypto?
So,
oh, no.
Volatility makes people search for security, right? And so they're pulling at straws if they feel like things are too volatile. And they're like, maybe my security's all in cash. Maybe my security's all in gold. Maybe my security's all in real estate, right? But here's the simple truth of it. No matter what you invest in, you're still in the markets. You're in an asset class. We talk about this all the time. There are
even when you go to cash.
Classes. Even cash. Now look at inflation, what it's done to cash. You know, inflation rate's highest in 40 years. You've lost 7 to 9% on the value of your money this year if you've just held in cash. So we have to stay invested, but diversification is the key. And Maggie, that's what I would say. I would say we make sure that we have a good representation of all 5 of those asset classes, customized to your allocation model and your risk tolerance, what we need to reach your goals in your situation. So the way that you spend and invest should be based on how your goals, what your goals are.
What your
so
goals
that's
are.
what we want to look at.
Yeah, while also looking at both short-term and long-term goals. We don't want to lose one and focus on the other. You've got to look at both short-term and long-term
Different
goals.
buckets.
And the way you invest those are going to look different in a bear market and in a bull market. It's just going to look different because the purpose of the money is different.
And I think the nature of Maggie's question, though, is there something better during this? Which means, what should I be invested in during this bull market? Well, you know, it's like, no, we have to try to explain to folks it's more about asset allocation that meets your goals, your objectives. And then there can be tweaks along the way, a little bit more here, another percentage over this way.
Sure.
But diversification means you're in those markets, all of those markets, the asset allocations that we've talked about on other shows, all of the time, but at a percentage that matches your risk tolerance.
Yes, that's key.
So how do you identify the risk tolerance?
Yes, everybody's looking for a magic bullet is basically what we're saying. Everybody's looking for what should I be invested in, no matter what the economic conditions are, to get me more money or more whatever it may be, to my goals quicker. The way we look at risk tolerance are what's the time horizon that you're going to look on each bucket of money. So if you are saving for a house or you're saving for a car, then we may not invest that in a 10-year bucket, right? Because you're wanting to spend that a lot sooner. If you're investing for your retirement and you're still working for the next 10 years, well, we're going to have a long-term goal on that, and we're going to allocate you differently. But whatever you have to be allocated, it's going to be very much diversified. And if there is a magic bullet, it would be diversification and making sure that you have the good representation of all those asset classes.
Well, and not just diversification of asset classes, but diversification within asset classes.
Okay,
Specifically,
you know I'm going to follow up on that.
layer.
What do you mean?
Yeah.
Again, we talk about it in layering. It's like an onion. You got to peel those layers off, and it's not just a simple diversification, stocks and bonds, right? But it's really is layering. It's much broader than people think. So it's not just in asset classes or asset classes themselves, but also the layering.
So we've got
beneath
stock
that.
funds, we've got bond funds. Those are in those 401ks at
Yep.
work, or maybe you like to play a little bit online. Let's say we're paying off our mortgage. Now we're in the real estate factor. We do have our emergency savings. We got 40, 50,000. So now we're in
You
the
have
money
cash,
market.
yeah.
What other ones am I leaving out though? I said stocks, bonds, real estate, cash. What else?
Commodities. I mean, you're talking about oil, and that's where gold could be a part of your
So it could be
financial
a
future.
percentage of your
Absolutely.
portfolio.
Part of,
Just
a part of.
You just don't want it
That's
all.
right.
Be weary of folks trying to sell you a one magic bullet stock
Right.
here. So we're going to put everything you have in X investment, right? That's probably not the right case.
Let me
There's
ask you
no
both.
get rich quick option here.
Okay.
Is the point.
Are insurance kinds of products or tools considered one of those asset classes? Things like annuities. I mean, if it's got a paper structure to it, is that
Absolutely.
an asset class as well, insurancing?
Well, you can define it sort of that way, but absolutely like an annuity, so to speak. And we could do a whole show just on annuities. I think there are.
We will in the future, I
I
promise
think
you.
there are good annuities and there are bad annuities, right? And so it's very specific to everyone's situation. But yes, utilizing a fixed or an indexed annuity that is going to bring you good return over time on a longer term plan could be a good fit for some folks, right? But there are other annuities that I would stay away from, and we could talk about those into detail as well. But yes, I think insurance products, making sure that you're protecting what you're working hard for is actually
that's
a
important.
huge goal that
And
everyone should have.
what most people don't realize is that their income or what they're earning, man, that's something big you've got to protect right there. And so when you're looking at those different things, you've got to look at asset classes, but then you also have these vehicles, investment vehicles. Those are two different things. So investment vehicles and then asset
That
classes.
are made up of asset classes,
right.
which you're talking about
That's right.
annuities,
Insurance
CDs, mutual
products.
funds, equity funds. All of these things are made up of the five major asset classes. So yes, they are a part of a financial plan that we would put together. I don't know how long we have till commercial break.
A little bit.
So
Give you a sec.
I want to walk into a little something else here. Is like, okay, if we're in a bear market, what should I do then? Because we're talking about diversification. And I have another chart that I actually want to show and give you a little bit of hope here. And this is showing that bear market recoveries are often front loaded. So if you look, the best 50 days is shaded in green there on that circle, is actually the best 50% of days are during a bear market. So meaning from that time frame, the 30 years of 92 to 2021, that 50% of the best days of the market are actually happening inside of a bear market. So if you totally dismantle and go all to cash or all to gold or all to one or other, you're going to miss out on some good returns that you are going to not be able to experience back. Now the chart on the left is actually going to show that a little bit more detail. This blew my mind when I saw this chart, because if you miss the top 10 days of a 30-year period, you would miss out on 54% of the gain
That's
that you could
huge.
get. You would be 54% less than if you would have just stayed
So if you just reacted to one bit of news one week, said, I'm going to move over here to cash, and it took you 2 or 3 months to get back in, just that one day of that over the 30 years.
You've lost.
You've lost out.
On potentially 54% if you've missed the top 10 days. Now, I want to get to that last statistic there, because if you missed the top 30 days, you would have 83% less if you missed 1 month out of 30 years.
So this right here is why you don't want to make fear-based decisions. Because when you feel the fear and you want to pull out, this is what you miss out on. You miss out on the upside from the bear market. You miss out on the increase as it begins to continue to move forward.
So if you have
and
a good plan.
the majority of those increases happen the first few days of the coming out of
That's
the
right,
bear
first
market.
full-
And
Yeah,
that's
on
another
the front
point.
end, they're front loaded.
And most people usually wait to get back in to hear the reports.
That's right.
That
And
the
it's
markets
too
are
late.
recovering.
It's
and
backwards.
You've,
It's
you've been
too
missing
late.
out on it.
Yep.
It's a whole other part of the conversation. I'm going to talk about holding periods and the actual past returns when we get back after this
Absolutely.
break. Folks, call Jay and Brittany right now so we can do a market review to make sure that you're not taking too much risk, but you're also not taking small enough risk that you run out of money in retirement. We need to make sure we still have small earnings in our investments. Don't jump out of the bear market just because it's happening. Get a retirement review, an investment and risk report right here. 866-691-7317 is the phone number. More with Jay and Brittany right after this.
When was the last time you saw your financial professional? Are you getting the most out of the strategy that was created for you? Although you've done a great job finding someone to help plan for your future, are you 100% sure that you were given the right strategy? We can help answer these questions and more with a complimentary second opinion evaluation. We will take a look at what you have in place and then help determine if you're well positioned to get the most out of your future retirement income. In the event that it is not, we can help by making suggestions and showing you how to get on the right path. You wouldn't get just one opinion when it comes to a major health decision, so why would you treat your most important financial decision with such disregard? Call today for your no-cost, no-obligation second opinion evaluation to see if you're getting the most out of your retirement income plan.
Welcome back. Here with Jay and Brittany Hagee, the co-founders of Allon Planning Partners. I'm your host, Spike Spangle. We talk about retirement solutions, investment solutions, tax solutions for you every single week. And, you know, one of the things about the holding periods, you had just showed us some great charts. If you missed them, don't worry. Call Jay and Brittany right here. You can come in for your own personalized review of your investments. But the holding periods inside funds, generally, from what I've read, people don't actually get the returns of those funds. Why is that, Jay?
Well, a lot of folks are looking, when you sit with an advisor, you're looking at average returns over a 5-10 year period, right? And they're showing you, hey, this fund has produced 10% return over a 10-year period or whatnot. Well, Vanguard did a study, and they actually used Fidelity data on retail investors. And did you know the average holding time of an equity fund was 27 months? So, you know, if the average retail investor is holding an equity fund for 27 months, you're not realizing a 10-year average, right? And
It's
why,
2 years.
And so why are they doing that, right? Most of the times they're doing that because they think there's something better. Like they've got, you know, there's something gaining more over here, or I'm losing too much, I got to jump over there. And we just showed if you miss the top 30 days within a 30-year period of whatever you're in the equity market, the S&P 500 is what that was, you would have lost 83% of the potential gain you could have had. So what we want to make sure we're doing is not jumping for finding the magic bullet and finding this and finding that because we have fear. And how do we dispel that? We put a plan together for you that you have correct allocation strategies so that you know exactly what you're invested in, how you're invested, and more importantly, why you're invested in that, so that when you feel the volatility, you know, oh, that's the bucket of money that's supposed to be a little bit more volatile, and then I can wait that out and get the full potential of that return or whatever that may be. So that's where we want to end up.
Yeah, and there are some things that we can take from experience in a bear market and apply that as we move forward, continuing in a bear market like we are. And the first is we cannot control everything. We've just got to focus on what we can control. We can't control the market volatility. We cannot control the rising interest rates. We cannot control inflation.
I wish we could.
But we can control how we're positioned within the market. We can control all of those types of things. So there are some things that we have control over.
You can't control what you pay for the investments. You can control the
Yes,
costs.
your
and
fees.
what
You can
choose.
control what you're willing to pay in fees.
That's right.
So focus on those things you can control. You can control your risk tolerance and what you're willing to risk, all of those things. The second thing is that you cannot avoid all risk. Just like we talked about earlier, if you're in the market, you experience market risk. If you hold all your funds in cash, you are experiencing inflationary risk. So there is going to be some type of risk
No matter where you're
experienced.
at.
But the thing is, you can control the type of risk and the amount of risk that you are willing to take. So you can't avoid it all, but you can choose, and that's important to learn. And then, of course, plan for the unexpected. because
Yeah.
it will happen. You know, those emergency funds, the unfortunate loss of jobs, making sure you have proper insurance coverage, not overcovered, not undercovered, but making sure that there is a plan in place for those things.
Yeah.
To
Brings peace of
try to
mind.
end on a positive, is bear market going to last forever? I mean, like when when we're in the
no.
middle of a tough winter or a really hot summer, you're
It
like, oh my
feels
gosh,
bad.
is there any
Yeah.
end in sight? But
Yeah.
will there be an end in sight?
Well, I think
There
we've
is an
proven
end in
that that
sight.
will happen. I think
History
we've
tells
proven,
us.
and history tells us
Yes.
that there is an end to it, and that the average bear market is actually much shorter than the average bull market, just from history. And we know that's not always the indicator of the future, but it's a good guide that we can look at. And so I will tell you, it's not always going to be bad. You're not always going to feel this way, but you do need to make sure that you have a proper plan in place so that you know if you should be feeling this way or not right now.
And
right?
when you do feel those things, that can be an indicator that, hey, it's time for a financial checkup. It's time to take a look under the hood and see what's going on and what is it exactly that's causing me to feel the way I'm feeling. Because what you don't want to do, again, is to make those fear-based decisions, because then you'll lose out on a lot of the gains.
We
like
say
we
it a
talked
lot
about
going
today.
out to break, but I want to really spend just a moment on it. Getting that review, if you're wondering right now what can you do about a bear market, is know your financial situation.
Right.
Know if you're taking too much risk. Know what your costs are. Know what your tax implications are. And that you can do by calling it. That is something active you can do.
Absolutely.
As opposed to just watching the news, reading stuff online, and feeling terrible, do something about it. Get your review.
Yeah, being proactive rather than passive. That is something that we can take away from the bear markets as well, is knowing that we have to be proactive and not
Yeah.
just passive and allowing things to control our trajectory, but us determining this is where I'm going and this is how I'm going to get there. And when you come down and sit with us, that's the thing we're going to talk about. We're going to talk about your goals. We're going to talk about your risk tolerance. We're going to talk about the types of fees you're paying in your current investments.
Right.
We're going to talk to ensure that you are putting enough away for your future, and to ensure that you have enough saved up to experience that picture that you have in mind of what retirement should
Absolutely.
be like for you, which looks different for all of us. We have those different visions, but again, keeping our eye on the prize, knowing this is the goal that I'm working towards, and having a true plan in place to get there.
Absolutely.
And we say it all the time. We're not trying to get anything from you. We really want to get something to you, and that's what you'll experience when you sit down with
Absolutely.
us at Allon Planning Partners.
Thank you so much. I'm going to say it for Jay and Brittany. Brittany shared this with me before. In a study from Vanguard, using a financial professional can increase your returns by over 3%. They help you with behavioral coaching, tax efficiency, rebalancing. Use a financial coach who can help you, who does this every single day in their offices. Call Jay and Brittany right here, 866-691-7317. Thank you so much for watching the Allon Exchange. We'll be back again with more retirement, investment, tax, and estate planning information next week.